Hey everybody, we're back. We're going to talk about legislation affecting financing. And this is anywhere in the United States, not just Maryland. Okay. Never mind. Okay, here we go. Okay, so these are the 4 lessons we're going to talk about. Predatory lending, lending criteria for granting a loan. The more you understand about the lending process, better you can help your customers. Okay, so let's go over the lending laws. Lending laws. Consumer Credit Protection Act. CCPA, created in 1968, includes the Truth in Lending Act, TILA. So the intent of the legislation was to safeguard the consumer in the use of residential credit by requiring full disclosure of the terms and credit and conditions in any offers of credit. TILA requires lenders to make disclosures that allow consumers to compare the costs of making a purchase using credit from different lenders. The trigger terms are down payment, payment amount, number of payments, interest rate. Mortgage lenders must follow these TILA. Mortgage lenders must follow TILA disclosure requirements. The statute is implemented through the Rule Codes and Regulation Z. And Regulation Z applies to all advertising that promotes credit. For the licensees, or for my future licensees watching this video, this means any real estate advertisements that include credit terms. Regulation Z covers all the ins and outs. And this is properly disclosed credit in any advertisement. So basically you need to be careful when you are advertising any kind of financing. But usually your broker will do this. This will not be something that most real estate salespeople will be doing. Okay, so the main thing you have to make sure you put in there is the down payment, payment amount, number of payments, not to mislead the consumer. And there's Equal Credit Opportunity Act prohibits discrimination. The Real Estate Settlement Procedure, RESPA, enacted by HUD, prohibits illegal kickbacks and referral fees. The lender must provide the buyer with a written disclosure of the estimated settlement costs, so there's no surprises. All right, let's see. What requires disclosure? Requires disclosure of loan terms and costs. Requiring full disclosure of terms and conditions. I wonder if terms and conditions is the same as loan terms and costs. I think it is. Let's put it on here. Truth in Lending. Requires written disclosure of estimated settlement costs. That's RESPA. Remember we just read this? Must provide the written disclosure. Prohibits lenders from discriminating on a protected class as ECOA, and requires lenders to demonstrate they serve the community's low to moderate housing needs. All right, I don't remember reading that. Let's go down here. Oh my goodness, look at all this. This is a lot of information. And if you would like a copy of this reference here, you can always contact me on my webpage and then put in the notes, lending laws cheat sheet, so I know which one you're talking about. I can go and try and find it for you and email it to you. Because this is a lot of information right here. And you have to understand a basic knowledge. All right, so here it is right here. Community Reinvestment Act. Offer loans to low to moderate income. Well, I should have figured that out. It's the last one on here, right? Okay. The last one, process of elimination. Okay. All right, lenders must provide the borrower with a disclosure statement. At what 3 points in time can a lender provide this statement to a borrower and still be within regulations? Okay, I'm looking for the answer over here. And I'm not seeing it. Okay, maybe this is it here. All right, it says a disclosure statement must include the right to rescind up to 3 days after closing. At what 3 points? Okay, I would say at the closing, at the time, and 3 days after. Let's try it. No. Okay, so at the time of the loan application, 3 days after, maybe a week after. I don't know. Let's try again. 3 days, maybe a week after. No. Up to 3 days after the location. Okay, so it would be this one, this one, this one, this one, and this one. Okay, I only got 3 days. That's it. So you can do it. 1, 2, and 3. Okay, regulation Z. All right, the 4 trigger terms right here. Percentage rate. Payment amount. Which of the 4 disclosures does the Truth in Lending Act make? Annual interest rate on the loan. The APR, any finance charges. The right to rescind up to 3 days. That's not on here. Financing charge, interest rate. That's the only thing it's got on here is 3 things. Total amount of payment. All right, let's try that, see what happens. Okay, PTIP. Doesn't require lenders to take PTI. TILA doesn't require lenders to take PTI. Okay. All right, so let's try one more time. Okay. So it's just principal and interest, not taxes and insurances either. Because, I'm guessing because these change so frequently. And if you're not closing for a year, insurance and taxes could change. Maybe that's why they don't require that. All right, pop quiz. You have a client who's selling his family working tree farm. Does TILA apply? If you need help, we added a new resource for you. Not every extension of credit falls under TILA disclosure. TILA applies to consumer loans. Commercial and agricultural loans are exempt. So, no. All right, rescinding or canceling a mortgage. In addition to placing requirements on lenders, borrowers have some guidelines, such as a cutoff point for borrowers to cancel a new mortgage on a residence they already own. What is the cutoff point? What is the cutoff point for people to rescind or cancel? What is the rules? I don't see any rules at all. Oh. This is closure, 3 days after the closing on the loan. What is the closing point? Let's see if that's it. That's right. This right to rescind only applies to refinancing an existing primary resident mortgages or new mortgages on an already owned resident. All right, loans available at 5% annual interest rate. Is this a valid one? Does it allow for that? Interest rate. I want to say it's a violation. I want to say this is a violation. That's a violation. Maybe. For a good mortgage, call Mike. Okay. So that's permitted. That's violated. That's permitted and that's violated. Permitted. No, violated, permitted, violated, permitted. So loans available at a 5% interest rate, annual percentage rate, is permitted. A guaranteed loan, I would think that would be a violation, but it's saying it's not, so okay. And this is a violation. All right, I just didn't do good at all on that one. All right, let's see. This one is permitted. This one is a violation. This one is permitted. This one is a violation. And this one is permitted. Okay, so if you need to take any screenshots, there you go. I gotta move on because we don't want to run out of time. I'm going to try to get all our unit done in one video. Alright, toxic loan. Certain loan features are considered toxic. 30 years, is that toxic? I wouldn't think so. I would think that would be. Lender points at 2% value. Let's see if we can find anything in here. Toxic. The loan should have no toxic features, which include payback longer than 30 years, negative amortization, balloon payments are toxic, lender fees and totals more than 3%, amortization payments, not toxic. Negative amortization and interest payments are toxic features. So if you need to take any screenshots of these questions to help you, remember what's toxic and not toxic. Alright, we discussed loan terms for qualifications. Now let's move on to borrowers. What do lenders consider when underwriting a loan? Alright, what do lenders consider? I guess it's right here. Ability to repay full. They consider this. Estimated mortgage payment, other mortgage payments on the property, value of life insurance policy. Great job. Okay, only because I've done this for a while did I get this correct. This just comes from experience. Alright, at this point, Mike distributed a handout from the Consumer Financial Protection Bureau on qualified mortgages. This is information lenders may use. All right, let's see what we got here. Open a new tab. What is a, wish I could make this bigger. What is basic guide for lender? But we're not going to be trying to become a lender. I mean, you could be, but in this class or this thing I'm doing right now, we are not. We are working on becoming a real estate salesperson. All right, so predatory lending. Well, that was only lesson 1. Let's hope the rest of these will go by a little quicker. All right, encouraging debt. What is predatory lending? It's lending that takes advantage of the consumer by encouraging debt, not disclosing fees, not disclosing the true nature of the loan obligation, basically just trying to anything to get a sale, refusing to give loan to consumer whose debt ratio is 50%, giving a consumer a loan they can't afford, encouraging a borrower to keep refinancing, selling a mortgage on the secondary market, disclosing only a portion of the fees. All of these seem predatory to me. Selling a borrower's mortgage on the secondary market is not, and giving a loan whose debt to ratio is 50% is not considered predatory, okay? This is not considered predatory, and this is not. All of them seem predatory to me. Okay. These things right here are considered predatory, so don't do them. No matter how bad you want to sell, don't be doing it. All right. Let's move on. I'm not going to read all of this because we are running. Well, maybe I have to. Oh, this is a question. Never mind. Okay. One of them demonstrates some predatory actions and the other does not. Which scenario could be considered predatory? All right. Came highly recommended. Bob does not feel any closer to home ownership. He provided W-2s, bank statements, car loans. He saved 10% for his down payment. His representative said he had to purchase something called PMI. That is not predatory. Okay, let's look at this one. He only saved 10% for his down payment. Representative didn't discourage him at all. He suggested he take out a personal loan and use that down towards the payment. Now that's definitely wrong because that's just going to add to your debt to ratio income. So that's considered predatory. And cashing in on more fees and getting a loan right before you do. You don't want to ever get another loan right before you get ready to close on a house. All of us know that have a house, right? All right, you can also find predatory lending floating in subprime loan markets. Which of these borrowers may be considered subprime? Bad credit, lack of credit history, a lot of credit cards. I think this one. Red flag. Poor credit histories are a strong subprime indicator. All right, subprime lender characteristics. It's a good idea to steer buyers clear of subprime lenders. It may be easier to do this if you know what to look for. What are the characteristics of subprime lenders? Not borrowers, but lenders. All right, let's see. Subprime. I'll sell a loan. Higher fees. Some lenders specialize in working with subprime, known as subprime lenders. Subprime owners are considered higher risk for lenders, and they usually will charge them higher interest rates and fees. All right, what are the 3 common characteristics? Higher fees, higher interest rates. Only 2 of them. Target low credit scores, maybe? Okay, there you go. Low credit scores. Okay, cracking down. Okay, that's after the 2007 and 2008 housing crisis. All right, we're going to go on to lesson 3, lending criteria for granting a loan. All right, what are the 2 primary factors that lenders look at when determining whether or not to make a loan? Borrower's credit worthiness and the property itself. Calculated LTV. Okay, LTV ratio. The lower the LTV, the more likely the lender is to make the loan. So what is the loan to value ratio calculated by the lender? Which would he use? Would he use the appraisal amount, or would he use the appraised value or the sale price? Probably the appraised one, I would think. Let's see if we can find the answer in here. All right, different LTL. People are more likely to invest in property that goes default on their own home. And it does not say. Oh, here it is. Lenders usually base it on the appraisal value. That's what I was thinking. No? Okay, never mind. Lender will use the lesser of the appraisal value or the sale price. Okay, so if the sale price is lower, that's what they would go on. All right, borrow documents. All right, they're looking for credit report provided, probably. Looking for bank statements, W-2s, pay stubs, tax returns. Was credit report on there? I can't remember. No credit report. Okay. All right, let's try this. Marriage license? I doubt it. They don't care whether you got a marriage license or not. Source of income. Which of the following income sources is the highest risk? That could create difficulty for a lender to approve a loan. Not enough money. Got to get more work than that. All right, let's see if we can get one more lesson in here before we run out of time. Okay. They need a promissory note or a deed of trust. Obligates the borrower to repay the amount borrowed. Is not recorded. Held by the lender until the loan is paid in full. When it's paid off, return to the borrower paid in full. Given the lender the right to sell the property if the borrower defaults. It's recorded in county land records. 2 of the choices refer to mortgage. Okay. So, is not recorded, the note is not recorded. Is recorded, is the mortgage is recorded. What? All right. Obligates the borrower to repay the amount borrowed is the note. And we are going to take the unit test in a separate video because we're running out of, this video is getting kind of long. 10 questions on the quiz. So in case I fail, in case I fail. Mortgage. Okay, let's check our answers. All right, if you need to take a screenshot, take it. Some of these questions will be on the quiz we have on the next video. Try and look for loan processing and closing if you're interested in taking the quiz. And it's going to be a question similar to this, but not the same exact. It should help you on your test. The more you do these types of tests, the better off you'll be on your test. All right, after the loan's closed, the promissory note may be sold to another lender. The sale of the note occurs because lenders that work on the primary market make loans and resell them to lenders on the secondary market. Disclosure documents provided to the buyer at the time of the loan application should put borrowers on notice that the sale of their note may occur, and will likely be reminded of that fact when they sign closing documents. But it's always a good idea to make sure any buyers you work with are aware that this can occur, because you don't want it to be an unpleasant surprise for borrowers. All right, let's see. The primary market lender the borrower chose may sell the loan to another lender. Borrowers may provide approval for the secondary loan in the case of the sale of the note. Must provide for approval, no. Even though the primary lender sells the loan, it'll continue to service the loan throughout the term. I'm not too sure about that one either. Okay, so got all them right. For those of us who have had homes before and still have a house, we already know this procedure, so it'll be a little easier when you take the test. All right, so the unit exam is going to be next. It's going to be on a separate video, so look for it if you're interested in taking it. It's 10 questions. Thank you all for watching. I'll see you on the next video.